Hi, today we're going to talk about SLV. It's a silver ETF. I'm going to be your host, Uncle Dan, and I'm going to present some research that I've put together. And I'd like you to share with me what your thoughts are around this research. And then together, we're going to figure out whether we have an opportunity to either buy silver or sell silver. Now, I'm going to start by just talking a little bit about what happened with USO, which is that oil ETF, because there's some commonality there where we're seeing a lot of interest in this ETF SLV, which has some similarities to USO in terms of popularity. So I want us to get down into the details of what this SLV is. So I have some ideas around it I'm sharing with you. Please take down any notes and put those in the comments down below. Through Mindshare, we're going to figure out whether there's a big opportunity for us to buy silver in what looks to be a potential inflationary environment. But this first video is just to figure out what is this thing, how does it work, who's running it. Please give a thumbs up if you think SLV is going to be a huge opportunity going forward. And then do subscribe if you want to keep evolving with our journey investing in the markets. Thanks. Hey, today I want to talk about SLV. I want to try to understand what does the prospectus tell us about what SLV is? How is it different from USO, the infamous product that took oil negative? Let me show you what USO looks like. Back at the end of April, made a low when the tanker stocks like NAT made their peak. Now, there were some interesting dynamics with USO because there were so many people in it. So USO purchased oil futures in the front month, and when they did that, they actually exceeded the contract limit of 25%. No one's allowed to own more than 20 or 25% of the total number of futures contracts. But so many people were buying USO expecting oil to bounce that the exchange came back and told them, you can't do that. But as a result of what was happening there, oil went negative $40. What you're seeing here is the second month futures contract trade at $6.50 when the front month oil futures were trading at a negative 37. And the reason it plunged is because there was no place to store the oil, the physical oil. So the people who wanted to sell the oil had no one to buy the oil, because if you did buy the oil, you had to take physical delivery of oil when there was nowhere to put it. So very interesting dynamic. Can we learn something from that with SLV? So we have something else going on here with SLV. Look at the volume in here and look where the price has gone. There's a low of 10. We're now at 26. The volume's picking up. It's pretty healthy volume in there, and the implied volatility is picking up as well. So if you look here, you can see the implied volatility was around 36% down here. That's the blue line, and then the purple line is the historical volatility. As you can see, they're creeping up to 100%. So we're starting to reach what might be a peak in here, similar to what we saw in oil in April. But let's think about how this contract works. Is this similar to USO? Does this SLV ETF, is this buying futures? And are we going to be in a situation where they're going to hold too many futures contracts? To figure that out, we need to go and look at the prospectus, which you can find online. You can Google it. So we're going to do that next. I'm going to Google search SLV Prospectus. Okay, and look, it's iShares. They are the ones. Why SLV? Exposure to the day-to-day movement of the price of silver bullion. Cost-effective access to physical silver. So remember, we're trying to understand how this ETF is structured. We know that with USO, which is that oil ETF, we knew they were using oil futures and got in trouble when they got too big because they owned too many futures contracts. What we're saying here is physical silver. I wonder where the physical silver comes from. Okay, investment objective, let's see, is to reflect generally the performance of the price of silver. Now we know physical silver trades for a higher price than SLV. I wonder if that's a normal occurrence. But let's look at the prospectus if we can to really drill down in. Now here's the total return, okay, and that total return represents changes to the NAV and accounts for distributions. Now there are no distributions from this account. Over 10 years, it's delivered a negative 1%. The market price Beginning August 10th, 2020, market price returns are calculated using the closing price and account from the fund. Prior to August 10th, market price returns were calculated using the midpoint price and accounted for distributions from the fund. Okay, so they're shifting from a closing price to a mid price. That's not a big deal. That's just, there's nothing there to worry about. Now the benchmark, okay, that's what we want to look at. On August 15th, 2014, the iShares Silver Trust began referencing a new performance benchmark, the LBMA Silver Price. Benchmark performance prior to this date reflects the London Silver Fix benchmark. Okay, so their performance benchmark is the LBMA Silver Price. I don't know what that is. We'll have to research that. Key facts. Inception date 2006. Now against the benchmark in the last 1 year has returned 17%, and the Slv has delivered 16.6. So it is actually underperforming the benchmark. Now that may just be their management fees. What do we see here? Ounces. Okay, here's something interesting. Ounces in trust. Okay, ounces in trust. 573 billion ounces. Now my understanding is there's 3 billion tons of silver in the world. We need to take a look at just how big of the global supply of silver is owned and being held in trust for Slv. I want to know whether there's a scenario similar to USO where the size of the fund gets so big it starts to disrupt the silver market. If they were to hoard physical silver, is there a scenario where there's no more physical silver for shorts to be able to borrow or for shorts to buy back? If not, then this would be similar scenario to a stock that's been sold short, shares that are no longer available, and then we would have a major short squeeze and the stock would go up beyond its fair price. So that's what we need to research. We need to figure out what kind of opportunity are we looking at here. And then we also want to know their net assets. 16 billion. We want to know how much this is growing by. We might want to start with the fact sheet. Generally reflects the price of silver. Trust is not an investment company or a commodity pool for purposes of the Commodity Exchange Act. Shares of the trust are not subject to the same regulatory requirements as mutual funds. Before making an investment, you should carefully consider the risks of this. Okay. This was back in June. June, net assets were 8.8 billion, another 100 million ounces since June 1st. So they're growing fast. There's a lot of interest in this silver. That's a basic fund sheet. Now we're going to drill down into the prospectus. You have to do your due diligence when you're looking at these investments. You need to understand how they're pricing it. You need to understand what happens when it grows. What is it doing? It's buying physical silver. What are the risks around how they manage that? The trust issue shares on a continuous basis. The trust issues and redeems shares only in blocks of 50,000. A block of 50,000 shares is called a basket. These transactions take place in exchange for silver. Only registered broker-dealers that became authorized participants by entering into a contract with the sponsor may purchase or redeem baskets. Okay, so they do blocks of 50,000 shares and they use that block or basket to buy physical silver and put it into storage. The date of this prospectus is July 1st, 2020. 476 million shares. Shares outstanding, 615 million. So on July 1st, there was 476 million. So another 125 million shares have been issued. The summary is materially complete. You should read the entire prospectus. 39 pages. Is that all it is? That's not too bad. Only 39 pages. Some of them can be 150 pages. On June 30th, the shares closed at 17 and the LBMA silver price was $17.85 per ounce. Except when aggregated in baskets, shares are not redeemable securities. We'll have to look at the risk factors. The shares are not interests in or obligations of either the sponsor or the trustee. The sponsor does not exercise day-to-day oversight over the trustee or the custodian. The sponsor may remove the trustee. The trustee is the Bank of New York Mellon, and the custodian is J.P. Morgan Chase Bank, the London branch. Seems to be a lot of gold and silver in London for some reason. The agreement between the trust and the custodian is governed by English law. The trust is responsible for day-to-day administration of the trust. It's interesting they're not doing it here in the U.S. The responsibility of the trustee, processing orders for the creation and redemption of baskets, coordinating with the custodian the receipt and delivery of silver transferred to or by the trust in connection with each issuance and redemption, calculating the net asset value of the trust in each business day, and selling the trust silver as needed to cover the trust's expenses. The custodian is responsible for safekeeping the silver owned by the trust. The custodian is appointed by the trustee and is responsible for any loss of silver to the trustee only. The trust seeks to reflect generally the performance of the price. The trust seeks to reflect, and they say generally because they're going to pay themselves money to do this for you. It seeks to reflect such performance before payment to the trust's expenses and liabilities. So that lagging performance may not even include their fees. The shares are intended to constitute a simple and cost-effective means of making an investment similar to an investment in silver. An investment in physical silver requires expensive and sometimes complicated arrangements in connection with the assay, transportation, warehousing, and insurance of the metal. Traditionally, such expense and complications have resulted in investments in physical silver being efficient only in amounts beyond the reach of many investors. The shares have been designed to remove the obstacles represented by the expense and complications involved in investment in physical silver, while at the same time having an intrinsic value that reflects at any given time the price of the silver owned by the trust at such time, less the trust's expenses and liabilities. Although the shares are not the exact equivalent of an investment in silver, they provide investors with an alternative that allows a level of participation in the silver market through the securities market. An investment in shares is backed by silver held by the custodian on behalf of the trust. The shares are backed by the assets of the trust. The trustee's arrangement with the custodian contemplate that at the end of each business day, there can be in the trust account maintained by the custodian no more than 1,100 ounces of silver in an unallocated form. The bulk of the trust's silver holdings is represented by physical silver, is identified on the custodian's or, if applicable, the sub-custodian's books in allocated and unallocated accounts on behalf of the trust, and is held by the custodian in London, New York, and other locations that may be authorized in the future. Retail investors may purchase and sell shares through traditional brokerage accounts. Because the intrinsic value of each share is a function of the price of the silver held by the trust, the cash outlay necessary for an investment in shares should be less. The shares are listed and trade on NYSE under the ticker symbol SLV. Let's see, because the expenses involved in an investment in physical silver are dispersed among all holders of shares, an investment in shares may represent a cost-efficient alternative to investments in physical silver for investors not otherwise in a position to participate directly. I guess it depends on how much they charge us. So this article from 2018 talking about JP Morgan hoarding silver. They're actually not hoarding silver. They're the custodian for the SLV ETF. So they're holding all the silver for that ETF. They're not hoarding for their own speculation. Now here we can see that the number of ounces being held by this ETF has jumped from 362 million to 500 million ounces. Now there's only 3 billion above ground. So they are holding a significant amount of ounces of physical silver. Are we going to run out of physical silver for those who need it for industrial purposes, or for those who are speculating on the price going up? That's the big question in my mind. Okay, that's what I got for you for the first video on SLV. There'll be more after this, but very interesting market dynamics going on in there. And I love the idea that we can contrast this with the experience we had with the USO, who had used oil futures acquiring the assets for the fund. Here we're doing physical silver. So good luck.